IFRS 9 is a global accounting standard for financial instruments like cash, loans, bonds, and shares. It replaced IAS 39 to improve clarity and relevance in financial reporting. The goal? Make financial statements more reliable and useful for investors and lenders. IFRS 9 simplifies complex rules and addresses weaknesses exposed by the global financial crisis. It's principle-based, focusing on economic reality rather than rigid rules. This helps companies present a truer picture of their financial health. Consistency across countries means easier comparison of results. A level playing field benefits everyone, investors, companies, and regulators. The standard is a major step forward in transparency. It marks a new era in how companies report assets and liabilities. IFRS 9 is now essential knowledge for finance professionals. It's about making financial information clearer and more comparable. That's why IFRS 9 matters so much today. IAS 39, the old standard, was complex and inconsistent. Companies struggled to apply its rules, making comparisons tough for investors. One big flaw: losses were recognized too late, only after clear evidence appeared. The 2008 financial crisis exposed this weakness. Banks reported losses slowly, delaying the true picture. Regulators and investors demanded faster, more forward-looking reporting. IFRS 9 introduced a new approach led by the IASB to recognize losses earlier. The expected credit loss model was a direct response to these global needs. Another issue: too many asset categories with complicated rules. IFRS 9 simplified classification, using fewer principle-based categories. This makes it easier to classify assets and improves clarity. The journey to IFRS 9 was about learning from past mistakes. Now, financial reports are more logical and easier to understand. IFRS 9 is a clear upgrade for global financial reporting. IFRS 9 stands on three pillars: classification and measurement, impairment, and hedge accounting. Classification and measurement decide how financial items are grouped and valued on the balance sheet. Impairment introduces the expected credit loss model, making companies consider future risks, not just past losses. Hedge accounting aligns financial reporting with real-world risk management, like currency or interest rate hedges. These pillars work together to create a complete, practical framework. Classification sets the initial accounting, measurement tracks value changes, impairment ensures losses are recognized promptly, hedge accounting reduces profit and loss swings, reflecting effective risk management. The result: financial reports that are more accurate and useful. Understanding these pillars is key to mastering IFRS 9. Each plays a crucial role in the standard's effectiveness. Together, they improve transparency and decision-making. IFRS 9's structure is designed for today's complex financial world. IFRS 9 simplifies asset classification with two main tests: business model and cash flow characteristics. The business model test asks how a company uses its assets, hold for cash flows or sell for profit. The SPPI test checks if payments are solely principal and interest. If both tests are met, assets are measured at amortized cost, common for simple loans and bonds. Example: a company holds a government bond to maturity, collecting fixed interest. It's classified at amortized cost. Assets held for trading are measured at fair value through profit or loss, FVTL, impacting net income directly. Some assets go to fair value through OCI, other comprehensive income. Most financial liabilities are at amortized cost unless held for trading. This approach makes classification logical and straightforward. Companies can now align accounting with their real business strategies. The result: clearer, more consistent financial statements. Investors and analysts benefit from easier comparisons. IFRS 9 brings much-needed simplicity to a complex area. The expected credit loss (ECL) model is a game-changer in IFRS 9. Unlike the old model, ECL requires companies to estimate future losses, not just react to past events. Companies must use historical data, current conditions, and forecasts to set provisions. This means losses are recognized earlier, making financial statements more prudent. For example, banks estimate ECL for all loans, even new ones, using default rates and economic outlooks. ECL has three stages: Stage 1 for low-risk assets, 12-month ECL, Stage 2 for increased risk, lifetime ECL, and Stage 3 for credit-impaired assets, lifetime ECL. Provisions reduce the net value of assets and impact reported profits. This forward-looking approach gives a truer picture of risk. It helps companies and investors spot problems sooner. The ECL model is a direct response to lessons from the financial crisis. It encourages better risk management and transparency. Financial statements now reflect potential losses much earlier. IFRS 9's ECL model is a major step toward more reliable reporting. IFRS 9 makes financial reports more relevant and reliable. Asset classification now follows business strategy, giving users deeper insight. The ECL model ensures timely recognition of potential losses. This shift from late to early loss recognition is a big improvement. Principle-based rules replace complex categories, making application more consistent. Comparability between companies is now much easier. Hedge accounting improvements mean risk management is better reflected in reports. Artificial swings in profit and loss are reduced. Investors get a clearer, more stable view of company performance. Transparency and usefulness of financial statements are both enhanced. IFRS 9 helps users make better decisions in uncertain times. The standard sets a new benchmark for quality in financial reporting. It's a win for companies, investors, and the global economy. Adopting IFRS 9 was a major shift for businesses, especially in calculating expected credit losses. It required new systems, data, and expertise, impacting profits and equity. Banks in particular saw changes in regulatory capital due to higher provisions. Companies now use more judgment and assumptions about the future. The upside? Better alignment of accounting with risk management. Management gains clearer insight into financial risks and can act proactively. For investors, IFRS 9 delivers more forward-looking, comparable information. Credit risk is easier to assess and company health is clearer. Consistent application across firms improves market trust. Reliable, transparent reporting supports financial market stability. IFRS 9 is a global response to past crises, making reporting more robust. It's essential for today's interconnected economy. Ultimately, IFRS 9 helps ensure financial reports tell the real story.